Well, guys, Tesla just reported, and they are down 0.8% after hours. They beat on revenue, $28.1 billion versus $26.53 estimated, and they were exactly even on earnings per share. 50 cents per share was estimated, and that's what they delivered. They're down slightly. This is a company that's actually, even though with all the bad news, all the decrease in sales, the stock is up. Proof that the efficient market theory is bullshit. Guys, welcome to our Everything Money Plus channel. If you like this, we go through earnings results, we go through news, we do 20 to 30 videos per month. Follow the channel, subscribe to us. We're gonna do a lot more videos that are really great. It's a great way to get a piece. Now, overall, the NASDAQ rebounded a little bit today, but still finished down 0.93. On the tail end of Netflix, everybody blames Netflix. They were down, what, 10% today after their bad earnings that we reported on yesterday? It wasn't even that bad. There's Netflix. They were down 10% today, $125. Guys, this is a company I've been wrong about for a while. Got down to 160, and I just saw their free cash flow and their earnings so different, and their free cash flow was so much lower than their earnings. I was like, I don't get this. And they killed it. They figured out a way to make the money happen. But it doesn't mean that this company's worth whatever price. They got a hit lately. This is why earnings are a good thing. For the stable and smart investor, looking at earnings is a great way to sit there and see the reactions from the market. For example, if you thought Netflix was worth $1,500 a share, you would love this because it allows you to go buy shares cheaper. If you think Netflix is worth $700 a share, then you're loving this either way because it's getting closer. That's the way I want you to look at earnings. Not as a way of dictating, oh my God, they did this and therefore they're great. No, it's, okay, they're going to do X amount return, X amount of growth in the next 10 years. In the short time, in the short run, people are going to overreact to things on the high and low. So this is what we want to see. So the market blamed Netflix today. You saw gold. Gold take a major pullback in the last few days. You guys know I own gold. I own gold miners. I've been talking about gold since it was $1,500 or $1,600 an ounce. Doesn't mean I'm right. It just means I saw a disconnect in value. And now that disconnect is much smaller. Okay, this is great. This is the things I want you to be able to do, to be patient. Because I've been buying gold miners for 2 or 3 years now and waiting patiently as gold is trucked up. It takes some time. Now everybody's talking about gold. These are the things I want you to learn as an investor. This is why I want you to sit there and understand a way of thinking. We're here to teach a principle-driven investing approach to thinking. And how we look at investments is the way you should look at all your money in a certain way. It's all about understanding what you're buying. And if you don't, avoid it. With Netflix, I didn't understand what it was at 160 because I saw profit margin here, free cash flow here, and I didn't see how it was going to connect. And they figured out a way to make it connect. And that's why the stock is up a ton. But even at $1,100 a share, it's still selling for 57 times free cash flow, 47 times earnings. Is that too much? I don't know. Our community members seem to think so. Look at that intrinsic value, 666. Mine was about 700 when I did it yesterday. All right, we're about in line here. I'm actually a little bit higher than the community members. I don't care about quarterly results. I love looking at them. They're fun to read to see what people are saying. Like, for example, in Tesla's current report, thank you to all our customers, employees, suppliers, shareholders who helped us achieve the result. AKA, thank you for everybody who doesn't hate Elon. That's all I read here, which is ironic because 10 years ago it was, hey, you don't like Tesla, you don't like Elon, you're the ant. It's like, well, wait a second. No, you just don't like Elon, and this is a bad PR move for Tesla. This is the big thing for Tesla. Here are their numbers. They produced over 447,000 vehicles and delivered 497,000 and deployed 12.5 gigawatts of energy storage products, which is a record for both deliveries and deployments. So they have a record of deliveries. Okay, that's pretty interesting. Let's see. This is their production and deliveries by car, Model 3 and Y. Other models, X and Cybertruck and other things. Yeah, they didn't do much of that. Guys, some big metrics I want to show you though. Look at this. Operating cash flow of $6.2 billion, free cash flow of $4 billion. That's incredible. I don't care who you are. That's an incredible, incredible number. Let's go check this out. Now here's the good news. Year-over-year growth in automotive revenues, 6%. Energy generation and storage, up 44%. Services and other revenue, 25% increase. These are good increases for a company that was shat on just a year ago, but that's probably why, because they were shat on just a year ago. Revenues up 12%, gross profit up 1%, but total GAAP gross margin down 1.85 from 19.8 to 18%. Now, guys, operating expenses up 50%. Income from operations down 40% for that exact reason. When you have such a big increase, that's a problem. Operating margin, guys, 10.8 down to 5.8%, which is still an increase over the last 2 quarters. They're still getting through this thing, and they might be through the mess right now. We don't know exactly. But guys, free cash flow, that's a huge number. $2.7 billion last year, $4 billion this year in the quarter. That's a ginormous number. They should be very proud of that. Oh, and by the way, it's a car company. It's still a car company. I don't care what you say out there. 90% of its revenue or more comes from cars. It's a fucking car company. Stop with this. Does it have potential for other things? Absolutely. Absolutely. But if I'm a douchebag, but I have potential for being nice, you don't call me nice. I'm still a douchebag. No difference here. It's still a car company. Doesn't mean you shouldn't have components of it that you sit there and say, okay, they can build their robotaxis and the robots and the humanoids and all that stuff and build it up. But if you're valuing the entire company based on those small divisions that haven't even taken off yet, you are just trying to justify a higher price. That's what I want you to remember. It is currently a car business with the potential for being something more. But these numbers are car business type numbers. I will say the energy numbers being up 44% is great. Big time revenue growth in energy generation and storage. Huge. That is awesome. Keep on going, Elon. Let's see what else they got in here. Now look at this drop over the year. Total production, 470,000 last year, down to 447. Okay. Deliveries. Their deliveries were records, they said. 462 last year, 497. They had a 495 back in Q4 of 2024. So increases there, but look at these drops, guys. 2%, 56%, 5% overall. Big drop. Total end of quarter operating lease vehicle count, up 1%. Global vehicle inventory, days of supplies. Oh, look at this. Their inventory is declining. 19, 12, 22, 24, 10. So that's pretty good. Their inventory is declining. And when inventory is declining, gets things off the books, allows them to go make more money, build more cars, etc. Look at these numbers. Tesla locations up 15%. Mobile, don't even know what that is. Supercharger stations up 16%. That is great. Supercharger connectors up 18%. This is the backbone of the global electric grid. They're trying to become the go-to, and I freaking love it. Tesla is guys, I gotta tell you, Elon's a freaking genius. He absolutely is incredible. He's going to the moon. He's making it made electric cars a thing again. He's making this infrastructure here for electric vehicles. It's absolutely incredible. More power to him. I hope he gets through this mess because it is kind of annoying. So guys, there's a lot of things going on here. The stock is barely down. It's down 1.2%. At the end of the day, what we're here to understand is that there's a difference between price and value. And Tesla's stock is up a lot lately. And that's great and dandy. Just 3 years ago, it was at $100 a share. Now it's at $438 a share. That's hard to wrap your head around. Is it a 4 times better business than it was 4 years? No, it's not. It's not at all. Is it overpriced right now? Well, my argument is it's mostly a car business now that's selling for 17 times sales. The average car business is 0.5 to 1 times sales. This is 17 to 35 times more expensive. Our community has an average intrinsic value of 186 and has a sell rating on the company. Okay, how do we determine these things? This is what's important with investing. You might love a story, but if you don't put the right price to it, you're making a bad investment. That is the 5th tenet of our principle-driven investing. Let's see what analysts think, because I really want to check that out. I mean, look at this growth. Oh my God, $1.70 in profit this year, going to $9.65 per share. Guys, I really hope Tesla becomes more than a car company. It needs to in order to justify this high valuation, this $1 trillion valuation or more. It needs to be more than a car company. If it's just a car company, it will not work on this valuation. People are going to lose a lot of money. But if you're overpaying today for that future potential, that's just as dangerous. Even if it does hit those goals, it's still bad. In 1995, 1996 to today, has made 10 times more money per year. The stock is about 10x. But from 2000 today, the stock is down. Why? In that one time period, for 4 years, it went parabolic like that. It still has 3 or 4 times more profit and revenue than it did at the peak, but it's still below that number. Why? Because if you overpay for something, it's going to be hard to make money on it, even if you're right. That's the problem. Imagine being right, but then realizing you overpaid. That's just as bad as being wrong. It is wrong. And that's the problem we have. Revenue growth, have a decline this year, but getting back up to big growth, over double in the next 4 or 5 years. They probably think that Elon's going to get through this whole mess. But the question becomes, what is the right price to pay for Tesla? So I'm going to pull up my last analysis on Tesla. This one's a tough one. So guys, the reason this one's tough is we don't know what those other pieces of the company can do. We can only speculate. And the speculation makes it difficult because the profit's not high here. Check it out this way. Forget about revenue growth right now. Let's look at profit margin. In the last 10 years, they had 8% for the last 10 years, 11% the last 5 years, 6.5% last year. I'm putting 15, 22, and 29, assuming that energy and all those other things kill it and they're high margin businesses. So I want you to keep in mind, my lowest profit and free cash flow are greater than my best profit by 50%. Think about that. My worst assumption is 50% better than their best ever. That's hard. That's really difficult assumption to make. Next, PE, 18, 23, and 28. This assumes it becomes more than a car company also. And my 9% desired return. Now back to revenue growth, I did 6, 12, and 18. I don't know where the right number is, but I want to show you this because this is what's interesting to me. If I hit the analyze button on this, this is where we're taking the story and the numbers together. But it's hard with Tesla because that story has a lot of unknowns. Remember, they said that full self-driving was the story 7 years ago. God, Paul, you don't get it. They're full self-driving. It's all self. And guess what happened? Nobody bought the FSD. It was $12,000, didn't sell. It was $8,000, didn't sell. Then it was like $99 a month. You got 2 months for free, and less than 2% of people signed up for it after the 2 months free. That's a flop. And now it's, oh, Paul, it's not FSD, you idiot. It's blah, blah, blah. It's Robotag. It's like, okay. But at some point, it's got to be more than a car company if you're going to value it this way. And let me show you how I value it. This is assuming, again, I want to repeat, this is assuming it becomes far more. In fact, this is assuming that the car company is the smallest portion of the business. That it's going from 90% of the business to a lot smaller portion of the business. Maybe 20% of the business. This is why it's hard. Low price of 85, high price of 577, middle price of 234, assuming that all the other parts of the business that we think are going to be awesome end up being awesome and perfect. Guys, if that doesn't make you think, I don't know what will. If it does make you think, we got a great place for you. Check out our community. We're looking for active investors who are trying to level up their investing game and surround themselves with good thinkers. We're not looking for people who just want to be told what to buy. This is not a channel for that. This is a channel for teaching people how to think. So if you're interested in that, click the link below, sign up for the community. We have a great 7-day trial. Not asking you to make a permanent life decision. I'm asking you to make a temporary decision and understand and make it. I'm not asking you to make a permanent life decision. I'm asking you to make an informed decision. This isn't for everybody. It's just for the right people. So if that's you, click the link below, sign up. I think you'll be proud of that. Thank you for your time.